Hey guys, this is Scott Horne, and this video is going to be about credit reporting for both a buyer and a seller in owner finance type transactions. So if you find this video helpful, don't forget to take a moment and like the video. Don't forget to comment below on anything. We'll do our best to answer those questions for you. And don't forget also to join our YouTube channel as well. So let's just jump right into this. And talking about when we're buying a property, how does credit really come into play with a seller? Well, when we're buying a home subject to the existing debt, you've got to remember that most sellers are behind in payments typically. They're in some kind of financial distress out there, which is why they're allowing us to buy that home subject to. Now, I get it, may not be always, but the great majority of the time, that is the case at least. And so one of the things I use when I'm talking to that seller is I explain to them how me buying that home subject to the debt and making their payments in a timely fashion for them will help benefit their credit over time. Now, I also take a moment and explain to them things like credit goes down a heck of a lot faster than it goes up. It's just the nature of the beast out there. But if their credit has been destroyed because of non-payments and things of that nature, they get to piggyback on my back of making the payments timely that will help them increase their credit score. And the absolute best way to increase their credit score is through a home mortgage. It's not credit cards or a car payment or things of that nature. It is the home mortgage. In fact, I've been told that could be up to 50% of your credit score rating alone. And so I love to utilize that as a conversation topic with them to help entice them to do the transaction with me. Now, down the road, a year or two later, as their credit is improving, maybe they want to go out and buy another home. I got it. But it's going to take that credit improving to help them buy the house. Then they ask the question, well, if you bought the home subject to the existing debt, how does that affect my credit and how will a mortgage company look at it? And of course, mortgage companies traditionally look at a sub 2 type transaction as a rental property where they take 25% of the monthly payment against the seller's debt to income ratio. Great. On the other hand, I've seen about half of the mortgage companies and underwriters, after let's say a 12-month good pay history, treat it as if the account doesn't exist and they move on down the line because the home has been sold. Every mortgage company does things a little bit differently though, but this is a great scenario for talking with your seller on how you can help them improve their credit score when you're buying that home subject to the existing debt. Now let's go to the flip side of the conversation and talk a minute about a back-end home buyer who buys the home, an owner-occupant, how credit affects them and us in these transactions. So first off, when I'm looking at a buyer to buy my home, the last thing I look at is the credit score. That really doesn't tell me anything. And so often, home buyers, oftentimes they have zero credit because they pay cash for everything. They don't have any credit out there. So I love that. And when you're talking about someone who has a credit score that has nothing on it, nothing positive or negative, to me, that is A plus credit because they have nothing negative. They pay cash for everything. They have no debt. It's an awesome scenario. Unfortunately, the mortgage world calls that C credit because they want you to have credit. They want to see your pay history and things of that nature along the way. But what I'm looking at really when I'm looking at an application for a borrower and that credit report is does that buyer have the sufficient funds for the down payment and closing costs we're asking? Do they have sufficient income to repay the loan? We call that the ATR rule, or the ability to repay under Dodd-Frank. Because what I'm really concerned about is I want to make sure I sell them a home at a price that they can afford because I don't want to set them up to fail. And guys, I don't need to jack my interest rates way up just to make a little bit more money. I can do just fine at reasonable interest rates out in the marketplace. Now, oftentimes buyers are going to ask, how this may affect their credit score out there. In addition, as a seller of the property, as an investor, you may want your buyer to be able to refinance 1, 2, 3 years down the line or something like that. Now, most investors, though, don't have the ability to report to a credit bureau. Now, if you're using a loan servicing company, which most of you do for wraparound mortgages, some of these servicing companies report to credit bureaus. A lot don't, however. And you don't have to have that to make this work. And so, what we learned many, many years ago is on an annual basis, we will write a letter to the three credit bureaus. We'll identify who bought the house, maybe provide them a copy of the note and deed of trust on the property, and we identify their pay history. We provide them the name of the buyer, their address, their social security number. We provide the pay history for January, February, March, April, on down the line, the amount they paid and the date they paid it. And they will take that and they will upload that to the credit, and you can send that to all three credit bureaus. Now, once you do that, you're helping that borrower establish credit, improve their credit. So if you're looking for them to cash out, this is a way that will help them do that from a refinance basis. And I want to make one more comment about owner financing versus a lease option, because when an investor is looking at having their borrower cash out within a reasonable time frame, a lot of guys like to navigate this under an option agreement, and that's fine. But when a buyer owns a property, when they create a pay history that can be provided to a future mortgage company, I will tell you as an ex-owner of mortgage companies that it is easier for the buyer to refinance than it is to go out and to get a purchase money mortgage. So there's lots of positives to helping that borrower do it. Now, if you're playing the note game where you're selling a note, maintaining that pay history, either through your loan servicer or yourself, is so important also, because a note buyer wants to see how that buyer is making payments for 6 months, usually 12 months minimum, 2 years or more. And that pay history will help you maximize your dollars when you're selling a mortgage. So I hope you all found this helpful and beneficial, talking about credit on owner financing, buying and selling. Don't forget, if you liked the video, take a moment and like it. And don't forget to take a moment to subscribe to our YouTube channel. We'll see you guys next time.